Do you want to break into the real estate market but don't know how? Maybe you have not the best credit and you don't have full-time employment, but you still want to get started. Well, today's video is for you because we're going to be talking about DSCR loans, which is a very valuable product when looking to start getting into real estate investing. I'm Hannah Escher. I'm a mortgage advisor and I own 2 properties myself. And I am so excited to share all of my tips and expertise with you, my fellow investors. Let's get started. What is a DSCR loan? DSCR stands for Debt Service Coverage Ratio. And what we're looking for in this loan is to have the cash flow of the property cover the liabilities of the property or the cost of that property on a monthly basis. This is different from a standard conventional loan where we're looking for your income to cover that mortgage liability. This product is a valuable product because it allows a multitude of borrowers to get into real estate investing, no matter if their debt to income ratio is high, or maybe your credit score isn't as high as it could be for standard conforming loans. So let's break down the DSCR loan a little bit more. First, what most lenders are going to be looking for is they want a coverage ratio of at least 1. That means that you want the cash flow of the property to be at least exactly 1, which is going to cover exactly the liabilities on that property, or you want it higher. And in my experience, most lenders are going to want it higher than 1 in order to have less risk that that property is going to go into default. Now, as we're talking about risk, a DSCR loan is not going to be at the same risk level as a conventional loan or an FHA loan that's backed by Fannie Mae and Freddie Mac and the federal government with those loan types. A DSCR loan is not backed by Fannie Mae and Freddie Mac and is not backed by the federal government. So you're going to be looking at this loan through private lenders who do not conform to Fannie Mae and Freddie Mac standards. This means the risk level is higher. Because of that risk level being higher, you are going to run into a down payment requirement that is also higher. So most DSCR loans require at least 15% down. Some require even higher than that. Now, if you have a really high credit score, your terms can be even more favorable. So that 15% down number, that is probably going to be for someone with a 760 plus credit score. If you're looking at a credit score in the 6s, maybe high 6s, you're probably looking at closer to 25 to 30% down is the requirement. Talking about credit score, this loan still requires a minimum credit score. Most of the time, that's going to be the high 6s, between 660 to 680. And again, if you're in that range, your down payment requirements are going to be higher. Now, this is a great loan if you're looking at single-family properties, condos, multifamily properties, and it will all depend on the lender you go through what type of property types they will allow. And this is where you'll want to shop around a little bit to see what options are available to you. Because again, since this loan isn't backed by Fannie Mae and Freddie Mac, different lenders are going to have different things they require, and they are also going to offer different perks to you. So you might have one lender that's going to let you go as low as a 660 credit score. And another lender might be like, I need a 680. So you want to look around, see what fits your situation the best, speak to your mortgage advisor about it, and they can help you figure out what might be the best next step for you. So who should use this loan? Well, you usually need to own a primary residence. That is most of the time a requirement. And this is a great product if you're already investing in properties. The reason being, again, we don't have to use your debt to income ratio. If you're a real estate investor already, let's say you have 1 to 2 properties, but if we were looking at your income versus your debt that's reported on your credit report, we'd be seeing that debt to income ratio way higher than what the standard conforming conventional loans would allow. This is a great product for you because we're not looking at that debt to income ratio. Again, we're looking at the cash flow on the property. So the biggest thing here you want to think about is, do I have have a high enough credit score to get good terms on this loan? And do I have a large enough down payment? The other perk and reason this is great for investors is most of the time you can close this loan in an LLC. Most conventional loans will not allow that. And most of the time you need some type of specialty product to close in an LLC. So this is a great loan if you're an investor and you keep your properties in an LLC or a different type of entity than your personal name. This can be a great option for that. Now, something to think about when you're looking into using this loan product is going to be the market rents in the area that you're looking to invest. Because something that you can run into is that your market rents aren't going to cover the liability on the property and that mortgage payment. So you want to make sure when you're looking at this product with your mortgage advisor that you're coming in with enough funds to be able to get your loan low enough to where your property can cash flow for that ratio. It's a very important part of the process, and most of the time with these loans you're going to use an appraisal to determine the market rents versus like a lease agreement. So that's something to keep in mind too. Now again, the requirements will depend on the lender you go through. If you have a lender who's going to allow you to use a lease agreement to show that cash flow, then great. Maybe that's going to be a bit of a simpler process for you to find that cash flow number. If you're using just an appraisal and that number has to be originated from the appraiser, then consider where that property is going to be and if those market rents can cover the mortgage liability. To summarize, a DSCR loan can be a great option if you have a good down payment already ready, you have pretty good credit, and you're looking to get into your next investment property that you know will cash flow over that mortgage liability. Again, the requirements most people are looking for is going to be a credit score usually above 660, a down payment of at least 15%, usually 20% or more, and also remembering that most of the time you need to own your own primary residence. In today's market, this is a great loan product for a real estate investor. One of the reasons being, besides everything else we talked about, but this really simplifies your loan application. I'm telling you, I've worked with real estate investors myself, and it can get so complicated when we're looking at adding in all their properties, all of the debt to income ratios for every single liability, mortgage, everything on 5 to 10 properties. That can become a lot. This product simplifies the process for you. We're not looking at that. We're just looking at the cash flow on the property. So there you have it, a crash course on DSCR loans and why they are great for real estate investing. Thank you so much for your time. I'm Hannah Escher. You can search my name on BiggerPockets. If you found this video helpful, like and subscribe to the BiggerPockets Rookie channel. Thanks for watching, and I'll see you next time.